Ivan, I'm going to start with you. Big day, big week for earnings. What are you looking out for today?
Well, I mean, we had good news from Apple last night, and Apple is definitely a market-moving stock, and it's moving the market this morning. I think that the announcement from Boeing was not as bad as feared. I think there is light in the end of the tunnel to get the MAX back in service, which is very important for the economy, for the airline industry, as well as Boeing. Even good news out of GE this morning. So we are looking for close to a 10% year-over-year gain in earnings after last year's decline, which is what I believe will be the upward catalyst for the market.
Is it as simple as to say Apple beat big on earnings, the market goes up another 10% within the next 6 months?
Well, I think we need to step back a little bit and look at what expectations have already been baked into the market. Obviously, we had a very strong rally in the fourth quarter, and we had significant multiple expansion last year. So we really need to see earnings pick up. And what Apple is a great signal for is that earnings have been turning around. Earnings for Apple expectations were extremely high heading into yesterday, and they beat spectacularly. It was a very, very strong report. So hopefully today we get Microsoft, Facebook, Amazon. So as long as some of these large companies can come in on the upside, I think that spells more gains for the market going forward because we can grow into the multiples that we're currently priced at.
But our valuations, which are pretty stretched right now, are they a potential headwind for any big market gains this year, do you think?
So I think it all comes down to earnings. It really, if earnings can materialize, right now we're looking at expectations at the end of last year were for negative 1.6% earnings growth. So that's what was already baked into our market price. So as long as we can surprise to the upside, as long as we can get positive earnings growth again, I think that will allow the market to continue to move higher.
Ivan, how worried are you that the market sentiment is predominantly being driven by 5 big cap tech stocks?
Well, but last year, the way Matt said it is right. Last year was the year of the P, this is the year of the E. But last year's rally was very broad-based. Almost every sector was up. I think every sector was up of the 11 economic sectors. And it wasn't really concentrated in a handful of stocks, even though you have skewed to very big cap stocks like Apple, Google, Facebook, Amazon that do get a significant amount of money that flows into index funds. But the rally has been broad-based, and we have had stocks like, for example, all through the time that Facebook was going through their controversy, they grew in their member base, and they grew their advertising revenue. Mm-hmm. And I think we'll see that again tonight when they report earnings. So the P rose last year, and this year it'll be the E.
All about the earnings.
All about the E, yes, earnings.
What about sectors? I mean, healthcare was sort of an underdog last year. I think it was like the second worst performing sector in the S&P 500. Do you see that things might turn around this year? We're in an election year. We talk about healthcare a lot.
That's a great point, Alexis. When you look at healthcare, it was the second worst performing sector after energy. And that was after a very, very strong rally in the fourth quarter. You finally started to see healthcare get rewarded and overcome some of those political fears. When we were speaking with clients earlier in the year, you could see earnings beats coming from some of the bellwether HMO companies like United Healthcare or Centene. You had earnings beat after earnings beat, yet the stocks were trading down because there was worries about Medicare for all and what that really meant. But I think as the market and investors have processed the fact that we're still likely to have a divided Congress, that really paves the path forward for healthcare. And so far this season, they've produced solid earnings again. And so healthcare really can be a place for opportunities because it's more than just HMO and service providers. You have healthcare equipment companies, which are doing very, very well and helping to innovate. You have healthcare technology, modernizing hospitals, modernizing data records, using big data to provide better outcomes for patients. So those are all areas of opportunity going forward in healthcare.
All right, but today I think it all belongs to tech and to Apple after its comeback quarter. See if that stock can hit another record. I think it probably will. We've got a new trading day underway at the New York Stock Exchange and the NASDAQ. We saw a nice pre-market rally, and the Dow Industrial is going to start the day up about 165 points higher.
Ivan, you mentioned General Electric. What did you like about the quarter? To me, it's nothing more than a momentum name. Their orders were down in a large number of businesses.
Well, I'm neutral on the stock, and I have been for a long time. But it's still important that GE perform well, again, for the economy, because it touches a lot of key areas. And so it's the underlying trend of these key companies that are important. for the market. Now, there's other stocks I like better. Like in healthcare, I like CVS. I think CVS is the model for the future of healthcare. With its merger with Aetna, you merged one of the biggest payers of healthcare services to one of the biggest providers. And they're also opening these healthcare hubs, or health hubs, which is a much more efficient delivery of healthcare services, like the Minute Clinic, like these acute care providers, combining that with the ability to get your prescriptions filled and buy other sundry and health personal care items in one place. I also like Lumina, which does genome mapping, which is really the future of healthcare, is trying to understand the causes and things like why we get the coronavirus and why it's so, in some cases, deadly. So these are key areas. I like the tech sector the best. The tech sector is where the action is, where the fun is. It's what moves society and the world forward. So, and which drives the growth. And what we see in the tech sector, these are intellectual capital intensive companies, not financial capital intensive companies. So they generate huge returns on capital, and that's why their stocks prices continue to rise.
You mentioned the coronavirus in there. Is that changing your equation at all for the market, maybe even in the near? It's hard to look out far, but in the near term at least.
You know, it's a great point. It's hard to know what's going to happen looking further out regarding this outbreak. Even looking at the near term, though, when you look at what Apple said, at what Starbucks said last night about the coronavirus, there are a few knowns. They know Starbucks has had to shut down a number of stores in China, but it wasn't enough for them to move any of their guidance lower. They kept their guidance the same. Apple is essentially saying, we're going to wait and see what happens with this. And when you look at whether or not this changes any of the underlying fundamental trends in this economy, the answer is no for the longer term. So perhaps this might create some opportunities, some potential entry points into companies. You look at the airlines, the U.S. airlines have lost billions of dollars of market cap, and China really hasn't been an area of growth for them lately. It's been one of the more sluggish pieces of their business model. So perhaps there could be opportunities in that space going forward. So whenever there's a wall of worry, there's opportunity.
Jared, over to you at the Wi-Fi Interactive Board. Interesting to me, Starbucks trading down. What bothered me off that earnings call, Jared, last night is that they gave no timeline or no material, just insight into the impact of the coronavirus. They're closing stores, but I think investors are a little worried about that.
Yeah, they really couldn't give much guidance at all because of that. And I think that was a little bit of a surprise. Here's what they've done over the last year. And we can see they peaked in July. Interesting, a lot of software companies peaked at the time, too. They eventually came back, but just kind of stalled. And we've been in a trading range since that time, roughly 80 to 100. So we'll have to see what kind of consolidation takes place in here. Is a little violation of the uptrend. And then just looking at the NASDAQ 100 heat map that we have here, Apple, again, is standout. That's got to be a record high, up nearly 3%. Microsoft up nicely, 1%. Facebook, Amazon as well. Now, the chip stocks suffering a little bit. That's because of that AMD guidance, which was a little bit weak. Just hit Applied Materials instead. But AMD here off 6%. But you go back over the last year, still up nearly 150%. Pretty impressive. The 10-year T-note yield not doing much today. And so if we look at the leaderboard in terms of sectors, we have industrials up nicely, 1%. GE and Boeing, both a big part of that. Energy, materials, and tech, all outperforming. To the downside, utilities and staples and healthcare. Those are the laggards today.
All right, thanks a lot, Jared. You mentioned the 10-year. Ivan, what about assets outside of U.S. equities right now? What looks attractive to you?
I don't really follow outside of the U.S. stock market, but emerging markets have obviously opportunities. I mean, the Asian markets sold off hard since the outbreak of the coronavirus, but I still think the U.S. is the best place to be. We are the driver of the world's growth. We are the driver of the world's innovation. So I like a lot of the U.S. companies.
Matt, we heard the likes of Starbucks, other companies just closing operations in China. Do you get the sense that the market has to re-rate for that risk? I mean, when you hear Starbucks say there is a material risk to their earnings and they can't even estimate it yet, doesn't the market have to pull back further?
The market as a whole, maybe not. Starbucks, I think we're seeing a little bit of that uncertainty baked into where the stock is moving pre-market. But when you look at what was good about the Starbucks earnings report, there was strength in the U.S. market. There was strength in their current consumer loyalty program. That was great. Cold beverages was a very, very strong part of the Starbucks earnings report. And that is all playing off of this theme of the strength of the consumer in the U.S. The consumer has been very, very strong in the U.S. And that's really been driving earnings of Starbucks and a number of other companies, not just consumer discretionary, but Apple, for example, with the wearables growth, and hopefully the services that can pick up leveraging the strength of the consumer. So I think we need to step back and look at those strong trends and what that really means going forward.
Well, I've definitely put enough money into the Starbucks cash register every morning. That much is for sure. Matt Orton, good to see you. I'm in Feinseth. Good to see you as well. And Jared Blikre, thank you so much.
Hey investors, Zach Guzman here. Are you interested in learning more about the markets and getting the latest financial news? Well, then click right here to subscribe to our Yahoo Finance YouTube channel. Get the latest up-to-the-minute market analysis, big interviews in the world of finance, and information on how to manage your money every day wherever you are.